Hi class, today we'll be looking at Chapter 17, Problem 2B. I'm going to share my screen with you. What you're looking at is a spreadsheet that demonstrates vertical analysis. What we've been doing in Chapter 17 is we've been analyzing our financial statements. When you are doing vertical analysis, it depends on the financial statement that you're analyzing as to what you do. What you will do is you will take each one of the income statement account titles and you will divide it by, if it's an income statement, the total sales. If this had been a balance sheet, then we would have taken the individual asset accounts and divided it by the total assets. And your liabilities and your owner's equity, you would take each individual account and divide your liabilities and your owner's equity by the total liabilities and owner's equity, which is also equal to the total assets. But in this illustration that we're doing, we're going to be completing vertical analysis on an income statement. And you'll notice on this particular income statement, they have 2 years worth of data. And that's so you can compare 1 year's data with the other year's data. But when you're doing vertical analysis, what you're simply going to do is you're going to take each year's amount of sales and you will divide it by the total of the sales account. So in other words, we're going to take this sales and divide it by itself, which means that that will give you 100% as a vertical analysis amount. The cost of goods sold total will be divided by the total of the sales. So in other words, 682,500 would be divided by 1,300,000. That would give you a gross profit percentage of 52%. Again, you're taking each one of the line items on the income statement and you're dividing it by the amount of the sales. So when we divide gross profit of 617,500 by our sales of 1,300,000, that'll give us a gross profit rate of 47.5%. Your selling expenses are done exactly the same way. Take the amount of the selling expense and divide it by the sales, and that will give you the percentage, vertical percentage for selling expenses. Take your administrative expenses, divide it by your sales, and that will give you the percentage for vertical analysis of your administrative expenses to the sales. So again, we're just taking each amount and dividing it by the sales, and that will give you your percentage for vertical analysis. And so each one of the line items is divided by sales. So I'm sure you can do that. You do the same thing for 2001. And then what you could do is you could compare what has happened from 2001 to 2002. You could also analyze it using horizontal analysis that we talked about in the last video for problem 17.1b. But in this situation, we're just doing it based on vertical analysis. Vertical analysis means we're starting with an amount and we're dividing it by the sales figure, and that will give you the percentage of analysis. And it allows you to compare 1 year to the other. So if we look at the net income for 2001, you can see for vertical analysis, we get a 14% amount. For 2002, it's 11.5%. So you can see that we went down from 2001 to 2002. You might want to analyze further to see why this happens. So you want to do part 2, which means that you're going to consider the relationship of each account to sales, and then you're going to consider the impact of the sales promotion campaign. Did the percentages of each element increase or decrease over the 2-year period? The net income as a percent of sales has decreased. So you can see that 14% went down to 11.5% in year 2. All the costs and expenses other than the selling expenses have maintained their approximate cost as a percentage of sales between the years 2001 and 2002. So what has happened is all of the expenses other than the sales remained about the same. They may have changed a little bit, but it wasn't enough to make any big difference. So what they're asking you for is to consider the impact of the selling promotion campaign on the relationship to its sales. And so what you'd be looking at is the selling expenses, and you can see that in 2001 the selling expenses were 15%, but in 2002 the selling expenses, excuse me, I'm wrong, I'm on the wrong line there, so let me back up for just a minute. The selling expenses for 2001 were 16%, and for 2002 they were 20%. So you can see here that the sales percentage has increased. But if you took this a step further and you looked at horizontal analysis, which was taking the difference between the sales of year 1 and year 2 and dividing it by the base year, you would be able to see that the selling expenses had actually increased, but not compared to the amount that the sales had increased. So the selling expenses or the new advertising campaign had not been as successful as they had hoped it would be. The increase in expense, in other words, in selling expenses for advertising has not produced the sales to maintain our profitability. Thus, the selling expenses as a percent of sales have increased. And so again, you could analyze that further by looking at horizontal analysis and comparing what happened with horizontal analysis to what's happening with your vertical analysis. Remember, with horizontal analysis, we found an increase or a decrease in our sales from one year to the next. And then when we divided it by the actual sales figure, it would have given us the percentage of increase in sales. For this particular problem, since your sales was higher in 2002 than 2001, there was an increase. There was a 10% increase in sales. Our selling expenses, notice, are higher in 2002 than 2001 also. There would have been an increase in selling expenses of 37%. So if you're looking at the differences, then you can see that the sales, if it only increased by 10% and your selling expenses was at 37%, that your new advertising campaign probably was not as successful as it should be. So what vertical analysis as well as horizontal analysis that we talked about previously in a different video means is that we can look at these figures and it will help management to make decisions about how to further operate the company. And so in this case, it looks like their sales campaign didn't do as well as they had hoped. And so they might need to try to reduce other types of expenses to get their net income to go back up to a percentage that is acceptable, or it just gives management guidance on how they should proceed in the future. And so that's all I want to talk to you about for this particular problem. We'll see you next time. Bye-bye.